Hi there, this is Alvin from Dr. Well. There is recently an image that was sharing around social media that got investors excited, and that was a Federal Reserve balance sheet. We know that the Federal Reserve have been doing quantitative tightening, that means trying to reduce its balance sheet and trying to sell the assets back into the market for the good of 2022. In just past few days, the $300 billion have removed half of the effort that was completed in 2022. So it was a very huge jump in the balance sheet, and with that doesn't mean that the bull market is going to come back and the good old days of quantitative easing and the rally is going to come once more. So investors might be thinking that maybe it's time to go all in, to buy, to go on the long side and make more money from the markets because the money printing machine is on again. But I have bad news to break to you. This is not exactly quantitative easing. So this 300 billion was due to the banking crisis where the Federal Reserve was lending out money, providing liquidity to the banks. It was trying to perform its role as the lender of last resort. So we won't understand that for the Silicon Valley and the Signature Bank, they are suffering from those very huge mark-to-market losses because they were holding the treasuries, and because of the rate hike in 2022, they have caused their bonds or treasuries to lose a lot of value. When the depositors started to withdraw more money, and that's where a bank run happened, the banks are forced to liquidate and sell this investment at a huge loss. That's why they couldn't cough up enough liquidity to return the money to all the depositors. And that's where the Federal Deposit Insurance Corp comes in and take over the bank. So we saw that in SVB and we saw that in Signature Bank. So the Federal Reserve is coming in with the liquidity to shore the bank's cash deposit so that they can continue to function. This is different from the QE, which the Federal Reserve is supposed to buy a large-scale amount of securities, whether it's bonds, whether it's mortgage-backed securities, they are buying in huge amount, right? So that is to flood the market with liquidity. This is different. This is loans to banks. If you really want to figure out where the money went to, so it is done through three lending programs. The first is this thing called the discount window. It is allowing the banks to borrow a lot of money directly from the Federal Reserve rather than from the other banks. And in total, there was $152.9 billion that was borrowed under this discount window. And second is the newly initiated bank term lending program, and that itself increased the lending by $11.9 billion. And the third one was because of the Silicon Valley Bank and Signature Bank, that was $140 billion lent to the new entity that took over these two banks. So in total, that's close to $300 billion, and that's how the Federal Reserve balance sheet was up. So it wasn't really quantitative easing, it was really pure loans to the banks that is in need of the liquidity. And these loans eventually will have to return because these are short-term loans. And how short are we talking about? So for those loans that are taken under this discount window, so the banks are supposed to return within 90 days. And for under the bank term lending program, it is 90 days to a year. So it depends on what are the terms because there were a few categories within this program itself. And the third, for SVB and Signature Bank, the FDIC is in the midst of recovering the funds from the investment or any assets that they could liquidate for these two banks, and in the meantime they need their liquidity to return the money to the depositors. So that's why they borrow money from Federal Reserve, and eventually they will return this money. So you can see all these are very short term. They are not there to stay in the Fed balance sheet for a long time to come. And if we take a look at the past, right, because this is not the first time that banks have tapped on this liquidity. It happened in the 2008 financial crisis. It happened during COVID 2020, and then now the banking crisis. Yes, you can see the discount window borrowing was a lot higher this time around compared to even the 2008 financial crisis. But what I want you to focus here is that they usually last for a period of time. Borrowing eventually get returned and the amount of lending just collapses, right? So I would expect this time to be the same. Eventually, the Federal Reserve balance sheet will reduce tremendously in a very quick time as well. So what does this mean for investors, right? Because we do see in the market some of the risk-on assets are moving, right? For example, the crypto, Bitcoin is up 13% in the past 1 week. ARK ETF that holds a lot of loss-making, high-growth tech stocks, disruptor stocks that are up 9%. And QQQ, which is the Nasdaq index, very heavy on tech companies, up 7%. Silver is up 5%. Gold is up 4%. So why is this happening, right? So there are three possible reasons. One possible reason is that because of the banking crisis, investors are very concerned about the financial system, how intact it is. and they want to move money out of the system. And that's why we see alternative currency like cryptocurrency, Bitcoin being the leader, right? Having the inflow of investments that cause their prices to go up. And we also start to see like a traditional store of value, gold and silver also went up. So some investors might really feel fearful about the collapse of the financial system, and that's why they are proactively moving money out of that system itself. And second reason, it could be because of the banking crisis again, and investors feel that maybe the Federal Reserve will think twice in the upcoming FOMC meeting whether they will raise the rates. So there was some speculation that the Federal Reserve may pause the rate hike in the upcoming March meeting and only reconsider in the future meetings. So the third reason could be because of the liquidity suddenly being shot up into the banks. The supply of US dollar has went up, and that's why the US dollar has weakened. So any investments that really benefit from a weakening USD like cryptocurrency, gold, silver tends to do very well when that happens. Whichever reason, I don't think that it is a QE effect that is happening. So definitely, I'm not as bullish as some of the investors are touting in the social media saying that this is a QE. But the way I see it is more like a very temporary short-term lending. Eventually, it will return back to normal. But more crucially is how this banking crisis will be resolved, because if it doesn't, the market will continue to be bearish. Right? So we do want to see the stability coming back. No banks are in trouble for the next 1-2 weeks. And the Federal Reserve, if possible, right, pause the rates for a while. So that could really give some more assurance to the investors, and so probably give some support to the share prices in the coming weeks. So I hope you understand the situation right now better. And remember to like this video, subscribe to the channel, and I'll see you in the next one. Goodbye.